Welcome to this explainer. You know, if flashing red and green numbers on financial news networks make your head spin, or the mere idea of day trading spikes your blood pressure, well, you are definitely in the right place. Today, we're taking it back to basics. We're going to trade that stressful, get-rich-quick casino mentality for a confident, slow, and steady approach to building wealth. Think of it like this. We're going to treat your portfolio exactly like constructing a solid, storm-proof house.
Okay, so here are our building plans for today. We'll start with the bricks to really understand stocks, then move to the mechanics of making money. After that, we'll sketch out the blueprints of risk and reward, map out a beginner strategy, and finally, cap it all off with the absolute magic of compounding. Let's get right to work.
Section 1. The bricks, understanding stocks.
So what is a stock? It's a word tossed around everywhere, right? From the water cooler to the evening news. But what exactly are you actually buying when you click purchase on some blinking ticker symbol?
Basically, a stock is literal ownership. It represents a fractional piece of a living, breathing business. If you buy shares of Apple, for instance, you transition from just being a consumer of their products to actually being a partial owner of the company. And why does this matter? Well, because as the company's total value, or its market capitalization, grows, your personal slice of the pie grows right along with it.
But you might be wondering, why would a massively successful company want to sell off pieces of itself to you and me? Companies sell these ownership slices through stock exchanges, like the New York Stock Exchange or the NASDAQ, because it's a highly effective way to raise cash. See, instead of going to a bank and taking on massive traditional loans that require heavy interest payments, they issue stock. They use that cash from investors to fund expansions, develop exciting new products, hire employees, or even pay down existing debt. So, by buying a stock, you're literally funding their growth, and in exchange, you get a seat at the table.
Moving right along to Section 2. Mechanics of making money.
So there are two main ways your new architecture actually generates value for you: capital gains and dividends. Capital gains are that classic buy low, sell high scenario. Profiting $20 a share if a stock jumps from $50 to $70. Dividends, on the other hand, that's passive cash. It's when a company takes a portion of its profits and simply hands it back to you in cash, literally just for holding the stock. Pretty great, right?
Now, to build confidently, you really need to understand the economic climate you're building in. You'll often hear the term bull market thrown around. A bull market is simply a market condition where stock prices are generally rising and charging upwards. Investors are optimistic, companies are growing, and portfolios are generally seeing those capital gains we just talked about.
But let's be real, the weather isn't always sunny. Conversely, we have what's known as a bear market. This is when prices are generally dropping across the board. And look, when you're a beginner, a bear market can feel absolutely terrifying. But understanding that this is a completely normal part of the stock market's overall volatility, its natural up and down movement, is vital. A solid architectural foundation is built to withstand both the sunshine of a bull market and the inevitable storms of a bear market.
All right, Section 3. The blueprints, risk and reward.
There is an absolute, unbreakable golden rule to your financial blueprints. Higher potential returns inherently require taking on higher risk. It's just how it works. A basic savings account offers essentially zero risk, but let's face it, practically zero return. As you climb the ladder, though, through bonds, into ETFs, and all the way up to individual stocks, your profit potential skyrockets, but so does the volatility. You just cannot have the high returns of individual stocks without accepting the high volatility that comes right along with them.
Because of that, you face a really critical blueprint decision. Do you buy into a single company like Microsoft, carrying all of its individual risk? Or do you choose an ETF, an exchange-traded fund? Think of an ETF as a diversified basket holding fractional shares of hundreds of top companies at once. If one company in that basket stumbles and has a terrible year, the hundreds of others help keep your foundation completely stable.
Section 4. The beginner investment strategy. Okay, step 1, build a liquid emergency fund for real-life surprises. You want this so you never have to panic sell your investments just to cover a medical bill or a surprise car repair. Step 2, aggressively kill high-interest debt because, trust me, 20% credit card interest will entirely devour your market returns. Only when those two pillars are firmly set do we reach step 3, which is investing consistently every single month.
Part of building a strong foundation is knowing how not to take a sledgehammer to it.
Ignore the social media hype and those flashy, trendy tips. Never, ever panic sell during a bear market drop. All that does is lock in your losses. Don't put all your money into one single stock and absolutely drop the get-rich-quick fantasy right now. True investing is a boring, beautiful, multi-decade journey where you focus entirely on the horizon, not tomorrow's weather.
Finally, Section 5. The magic of compounding.
Compounding is so insanely powerful that Albert Einstein allegedly called it the eighth wonder of the world. It's simply when your money starts making its own money. You aren't just earning returns on your original cash anymore, your previous returns actually start generating their own returns. It's this incredible snowball effect, where eventually your bricks start multiplying and basically laying themselves. Let's put this incredible concept into a real-world perspective to show you exactly why this matters so much. Imagine you start with our beginner strategy. You simply stick to the plan, ignore the daily market noise, and invest $200 every single month. Let's say you achieve an average annual return of 8%, and you do this consistently for 30 years, just $200 a month. Boom! Those small, consistent bricks multiply into an accumulated wealth of over $300,000. That right there is the architecture of wealth in action. It's not about finding one magic stock that shoots to the moon overnight. It's about time in the market, consistency, and letting the math do all the heavy lifting for you.
As we wrap up this explainer, I really want you to remember the simple, proven formula. Earn your income, save by building your emergency fund and clearing debt, invest consistently into diversified options like ETFs, stay invested through the ups and downs, and just let compounding work its magic over the decades. Investing is a tool for building long-term wealth, not a get-rich-quick scheme. So, looking at your own financial blueprint, ask yourself, what is the very first brick you are going to lay for your future today?